Right, good afternoon, everyone. Thank you for joining the session to look at credit insurance within our industry. I've actually split this presentation into two parts. So we're going to have an industry overview, and then we're going to have a little bit at the end about on how NMBS operates this for the benefit of its membership and for NBG partners. So there'll be a chance to ask questions at the end of each section, and I will try to answer them. I can't really go into too specific details on an individual basis, but if you want to catch me afterwards, then that's not a problem. So, okay, so as Mark said, I'm Finance and Operations Director and have been for almost 17 years now, actually, with NMBS. I joined at the height of the financial crash. Chris Hayward told me that I actually brought it with me. I didn't, but I was there, left to sweep up together with the team to get us through that and various other challenges in between time. So let's just have a quick look at what's actually going on in the credit insurance for our industry, the merchanting industry. So headline news, and it's very depressing at the moment because it's all quite familiarly depressing. Failures in what is labelled as construction, and I will come on to that a little bit later, are at a record level. Had a recent meeting with Allianz, who are the biggest insurer in our sector, and basically they're saying, yep, it's pretty bad out there. There's lots of failures, lots of payment plans, and I think that bears testament to what's happening in our sector. It is tough out there for construction and also for merchants. So here's a few headlines that have occurred recently. Now, I know everybody likes a graph. So here's a picture, and it's not a very pretty one because the blue line at the top shows the uptick in construction insolvencies for this year, although not as high as Q2, but it is on an upward trend nevertheless. Excuse me a second. So what do we mean by construction? Because builders merchants do seem to be labelled with the construction umbrella, if you like. And that's the question I'm already asked, well, quite often asked, well, what does builders merchanting have to do with construction and why are we labelled as such? Of course, there is an intrinsic link between the two, which you can't deny, between construction and merchants. The one couldn't survive without the other. So yes, there is an intrinsic link there, but generally NMBS members and NBG partners are rarely directly connected to construction. By that I mean infrastructure and housing. The majority of merchants service the RMO market, with construction being a smaller part of the whole. So working together, having been tarred with the same brush, the BMF and NMBS are trying to persuade the Association of British Insurers, or to re-educate them effectively. And the ABI, their members constitute the major credit insurers and other insurers, but the message isn't quite there yet. So how does this impact upon the merchanting sector? Well, it's important to know who these people are because there's even more of them now. In 2008-9, there was a few. Now there's even more. And I've just put some names up here, which you're probably already familiar with. But they have become of great importance, sometimes having onerous effects on the capability of business owners to both grant and take credit. So it's important to know who these people are, particularly as the market has grown. So here's a few. The names might be familiar. I've already mentioned Allianz, which recently changed its name from Euler Hermes. Each of these has an influence in our sector to a greater or a lesser degree, and the top four being more prevalent than the bottom four. But as I said, there are others. You may currently credit insure, and your insurer isn't on this slide. Don't read anything into that. It means that I've just named the top 7 here in terms of size. So how can you influence the decisions that are made on your businesses? So if you look at this from a purchasing side, it's important to get the terminology right because A credit insurer will refer to your company as a buyer, which is a bit odd because you're not buying anything, but you are intrinsically buying or trying to purchase goods, but they refer to you as a buyer. So what can you do to have an impact on the decisions that are being made? Well, the first thing is statistics, because insurers love statistics, and they will interrogate your filed accounts and any any additional information that you may provide to them. There are key measures that they look for which you should be aware of, which I'll come on to in a bit. But learn what they are and see what you can do to improve them. There is a requirement to file your accounts at a company's house for the majority of NBG partners and NMBS members. That's assuming that you're a limited company. Make sure that these are filed on time and, if possible, at the same time as in previous years. And you wouldn't think that would make a difference. But if you, for example, filed your accounts in July one year and you did it in August the next year, the credit insurers will be looking out for it. And whilst it wouldn't be a late filing, they do look at it as if to say, well, why are they late, in inverted commas, when they're not late? Why is the timing difference? So just be mindful of that. Anything that they ask for, give it to them. So if they ask you for management accounts, give them to them. That gives them the confidence that you're able to prepare management accounts. And don't forget, a lot of smaller merchants may not be able to do that. But if you are able to give them that management information, then do so. It will only stand you in good stead if you're able to provide it upon request. Again, if they ask you for other information, give it. What other information could they possibly ask for? For example, if you have loans, they might want to look at the terms of those loans. They may want to look at the covenants on any overdraft or borrowing that you may have. If they ask for the information, don't be shy in giving it. It is important, really important. And fix the roof when the sun shines. Now, I'm not here to tell you how to run your businesses, far from that. But it is important that if you have some good performing years, that you don't actually take it all out as take the profits out as dividends, but actually leave some there, leave some fat on the bone. So when you do go through the lean times, then you have something to fall back on. Might seem obvious, but a lot of merchants don't do this. So apparently this quotation was attributed to such diverse people as John F. Kennedy and George Osborne. He probably pinched it. But when the times are good, build your reserves for the rainy days that will inevitably come. Okay, so what are the key statistics that they are looking for? And again, another quotation for you, often attributed to Mark Twain, that there are lies, damn lies, and statistics. Well, the credit insurers like their statistics. And here's a few that you may want to be able to calculate from your financial statements so you know what they're looking at. And the first one is quite a common one, which is called current ratio. And that's the ratio of your current assets, so your stock, debtors and cash, to your current liabilities. That's your bank overdraft, trade creditors, PAYE, VAT, hire purchase, or anything else that you actually owe that isn't considered to be a long-term liability. Because the key word here is current. So it's anything that moves frequently, that is fluid, and does not include any long-term debtors or creditors, such as bank loans. And ideally, the credit insurers like this to be greater than or equal to 1.5. Now, that's what they would like. It doesn't mean to say they always get it. But these are, if you like, the halcyon numbers to work towards, in their view anyway. Another is liquid ratio. So liquid ratio, this is the same as current ratio, but it excludes stock. And the ideal figure for this is 1. And I'm just going to put up on screen a very quick example of this calculation so that it sort of gels for you. And it is very, very quick. Here's a simple example. So an extract from a fictional balance sheet showing current assets and current liabilities. I've plucked these figures out of midair So don't tell me that the stock turn isn't good enough or whatever. I just really haven't made this up. It is fictional. So for the current ratio, the calculation would be to express 350, that's the total of the current assets, as a ratio of the 95, which is the current liabilities. So this one is well within scope. That calculates at 3.68. So well within the parameters the insurers are looking for. On the liquid ratio, remember we exclude stock from this calculation. So we're looking at 250 as a ratio of 95, which equates to 2.63. So again, within the parameters required by the insurers. So the lower the debt in the current section of the account, the better that this is for these ratios. And the majority of builders merchants meet these criteria, but it is worth keeping an eye on them and recognising the effect. For example, holding too much stock. I don't have to tell you the pains of holding too much stock, apart from where to put it, but also it can be considered to be dead money. That can seriously impact upon your statistics and also tie up working capital. Now let's move on to something that's been prevalent in our industry over the last few years, private equity. Private equity has entered into the merchanting sector, resulting in consolidation and the creation of some very large groups. Whether you love them or you hate them, they're here to stay. But I just want to show you some of the pain that they're going through at the moment because of the nature of their model. The funding model of PE-backed companies is such that performance is looked at in a very different way. It's now not just at what level profit is made, but at what level it is made. Sorry. So EBITDA is the benchmark, and EBITDA means that you look at earnings before interest, tax, depreciation, and amortization. So why is that so important to private equity companies? And it's important because PE-backed companies normally have high levels of debt. So if you exclude interest payments from your measure of profitability, it makes the performance look better. Equally, depreciation and amortization, they're non-cash items and so are excluded. You might think it's a bit like window dressing a little bit. It's manipulating the figures. It is. But having said that, these are the rules by which they play. And generally speaking, the insurers are looking for net debt to EBITDA to be 5 times. I'm not going to go into what is included in net debt because it depends on who you speak to, but also EBITDA to interest coverage. So it's all right taking interest out of the equation, but you need to make sure that actually your EBITDA covers the interest that you've effectively got to pay across. So again, this makes your performance look better. So it's all very murky. And truthfully, it won't affect the majority of builders merchants, but I'm mentioning them here to give you a complete picture of what's going on. And I'm not going to give you a worked example of this because of the different interpretations of what is included in net debt and sometimes what's included in EBITDA. Equally interest, does this include deferred interest? So when you ask an accountant a question and the answer is it depends, well, it does very much depend, unfortunately, in this particular instance. So moving on, this information is in the public domain, but it will show you what constraints are actually within our sector at the minute at this level. So revenue is down. This is Travis Perkins, if you haven't worked it out. Revenue's down, operating profit's down, operating margin is down. So it's all bad news at the moment. And I believe if you were to pull the information on Stark, it'd be pretty much the same. So what are the credit insurers doing now? Well, it's quite simple. The rain's come in, so they're taking their umbrellas in. They are effectively cutting limits. So it does beg the question, is there enough credit in this sector? You know, we've got a new government whose mantra is build, build, build. Well, they can't build without merchants to supply the goods. And if merchants can't get the credit, then it's all going to become a bit difficult. So consequently, cover is being withdrawn on a significant scale. Some insurers actually have too much exposure within our sector, in particular Allianz. They have way too much exposure and are cutting limits. But if you look at the reality, where turnover is reduced, margins are under pressure, it's difficult to make a profit at whatever level. Doesn't mean to say whether that's EBITDA or proper profit, as I'll call it, particularly if everything is soaked up by interest charges. So the PE-backed merchants and others with high borrowings are having their limits cut as a result. And I will come on to what NMBS is doing in a minute, but that is at the top. This is an opportunity for, as I always say, out of a problem comes an opportunity. It is an opportunity for independent builders merchants who are competing against the bigger boys who can't get their credit in place. So, as I've said, turnover down, margins reduced, EBITDA not performing, there's a downgrade of limit. So I've deliberately repeated this slide because this is what you can do as an independent builders merchant to help your positioning. Understand what the insurers are looking at and see how you can influence them. File your accounts on time. If they ask you for anything apart from, giving a kidney or something like that, give it, because the more information they've got on you, the better. Even if it's bad news, tell them, because they'll only make their own minds up if you don't. And again, fix the roof when the sun shines. So I'm going to pause at this point because this is sort of the halfway point with regards to this presentation. That's the bit on the sector. So does anyone have any questions at this point? I think I have to stop presenting to actually see if anyone's got any questions. No questions. That's good. Mark, would you like me to carry on?
Carry on, Julie. Thank you.
Okay, thank you very much. Okay, so now I'll come on to what NMBS is doing and how this impacts upon your business. So I'll just need to click through a bit. Bear with me. Okay, I'm going to give you a potted history of NMBS's credit insurance arrangements. The reason why this is important is for you to understand where it's come from, how it's developed, and how it's served the NMBS members over a significant period of time. So in 2008-9, which I've mentioned far too many times already, insurers withdrew cover on an industrial scale. At the time, NMBS directly insured with Euler Hermes with a very small discretionary limit, and all limits were cancelable. So basically, if Euler Hermes said that limit's gone, that limit was gone. Their actions meant that NMBS was out of control. And importantly, in order to guarantee payments to your suppliers, NMBS needed and still does need the safety net of credit insurance. So out of this came a formalised credit policy, which has been in the cornerstone of what we do since 2009-10. We then undertook a feasibility study to try and change the way that we approach this. And following that feasibility study, which was undertaken with PwC, it was determined that we needed something different. We needed another solution because we had to safeguard the society for its members, and also to maintain the primary USP, the debt pledge. So working with a broker and our intermediary, our first captive was established in Bermuda. And this gave NMBS more control of the underwriting pen. It meant we were more in charge. And it was capitalised in order to support the limits being withdrawn. And at that point, ironically, our reinsurer was Euler Hermes, but it was a different part of Euler Hermes. So our first major test of this program came with the Unima amalgamation, which some of you may or may not remember. Yes, it was 10 years ago. So NMBS had mutual members who kept a foot in both camps. And what I mean by that is NMBS gave a credit limit and Unima gave a credit limit. Both members enjoyed both credit limits. But in credit world, 1 + 1 does not equal 2. So combining the two was quite a challenge. By this time, we'd moved on from Euler Hermes to a more receptive insurer who understood us a lot better, it's fair to say. We managed to accommodate all of the limits. But because of the lack of governance and accountability of Bermuda, which is, after all, designed for the US market, it didn't quite fit the bill. So we moved everything to Guernsey, we now have what's called a cell, NMBS IC Limited, so a separate limited entity, and the funds were moved from Bermuda to Guernsey for that very purpose. We then switched insurers, so 2015, 2018, we switched to Euler Hermes excess of loss, and that is important because we are no longer directly insured with Euler Hermes or Allianz. We take control of our own limits. And just to show you what this actually means, this is our credit limit range. I'm not giving anything away here because there's no numbers on it, but basically you might just see that very fine sliver there. Those are the people who have members who have limits in excess of 10 million. The rest are all within our control, and that's the bulk of them, as you can see. And that's why this works, because NMBS writes these limits, no one else. They're also non-cancelable, even under our discretionary limit. So it means that the insurers cannot turn around and say, we don't like the look of this week, you need to pull your limit, because it is well within our control. And this is the structure, this is how it works. And it's important to realise how this works, really, because we have pushed and pushed our insurer further away from any likely claim, which means effectively the bulk of the risk lies with NMBS, and that's why our credit risk management program is so critical to what we do. So here's a few facts for you on this. So 99.3% of all credit limits are set by NMBS, not a credit insurer. And at any one point in time, we're providing into this industry over $500 million of credit. At any one point in time, this may surprise you, especially if you personally are hitting up against your credit limit. At the most critical time of the month, which is usually the end of the month, about only half of this is being used. Of course, you do have people who use their credit limit a lot more, but this is an average. And we have 100% coverage on all members, and that means that anybody who wishes to come via NMBS, excuse me a second, any supplier who wishes to be insured through NMBS, all members are covered, and it's covered up to 100%, so we don't just take a partial cover on it. So this supports our NMBS debt pledge to suppliers, which they really forget about when we're all fat and happy. But when times get a bit lean and things get a bit strict, they do rely upon this quite significantly. We are independently audited twice a year. The purpose for that is to give confidence to our membership, our board, and also to our suppliers, because they put place credit insurance on NMBS too. So it's good to have that safeguard. We don't allow trading over limit. So if you do go over limit, before we make the call, we will see if we can increase the limit. But generally speaking, we will ask you to put a payment on account. And one thing that is really important is all of these limits are non-cancelable for the policy period. So regardless of what happens, your limit is in place for the policy period. So that's for a calendar year. And there's a minimum limit of £100,000. So how does NMBS set a member's credit limit? Well, there's various different tools in the toolbox. But mainly we do a calculation based on balance sheet value. That means your net worth. So at the bottom of your balance sheet is a number, and that's the number upon which we do a calculation. But it's not just the only thing that we look at, because we also look at credit referencing agency. And because if a credit referencing agency agrees that it should be at X, but our calculation is at Y, we take the higher figure. That's just another part of the jigsaw. We also look at trading history. So if you've been trading with NMBS for a long time, then we will look at the highest value that you've actually paid within the last 12-month period and set a credit limit based thereon. There's also an additional flex if you pay your account by direct debit, and also there is an additional flex too if you have satisfactorily operated your account within recent history, shall we say. Coming back to direct debits, actually, 22% of our members now pay us by direct debit, which is efficient for them and it's efficient for us as well, plus the additional credit on top. Now, if your limit that you need goes over and above our discretion limit, then and only then do we have to go to our credit insurer to seek permission for that limit. So how can merchants grow their NMBS credit limit? That's assuming that it's under the NMBS DL. That's DL is discretion limit. Well, you can improve the net worth of your business, so make and retain profits. And I am not here to tell you how to run your business. Please don't take it that way. What I'm saying to you is if you do that, then it stands you in good stead from a credit limit perspective. It's entirely down to you how you do it. Keep your NMBS account as clean as possible, as clean as it possibly can be. And you can sign up for direct debit if it works for you. 22% of members pay that, so it does make quite a bit of difference. Promptly file your accounts. This echoes what I mentioned earlier on, because it's more important here because the credit referencing agencies will actually look to see if your accounts are filed, and what they do reflects upon the rating that they give you. So it's important to keep those ratings as high as you possibly can. And if you are over our discretionary limit, that's when we need to bring in the reinsurers. So it is dependent upon the Allianz actually giving us that limit. We've only got 8 limits now, which are under the direct control of Allianz. So out of 1,260 members, you can see who's got the power of the pen, effectively. And what I would say is follow the advice given above. Actually, this advice doesn't really matter whether you're over our discretionary limit or not, because it is good advice. So key statistics, know what they are. File your accounts on time. Give any information that they ask for, and especially management information, and fix the roof when the sun shines. So that's the end of my presentation. Hope you're all still awake. Thank you for listening. I know it's a bit of a heavy topic, but I'm quite happy to answer any questions should there be any at this point, and I shall stop sharing my screen.
Well, thank you, Julie, on behalf of everybody. I'm sure if it was a physical meeting, you'd be getting a round of applause, but it's Kerry is obliging. That was really informative. I hope everybody enjoyed that and learned something from it, Julie. Really appreciate it.
Thank you very much.